So let's start by understanding the most popular route of stock market investments, the mutual funds. What is a mutual fund? In simple words, a mutual fund is a pool of investments into stocks, bonds, commodities, or a combination of securities which is managed by a professional. These mutual funds are managed by asset management companies or AMCs, which are registered with regulatory authorities and are licensed to offer these products to investors. So let's understand this with an example. Supposing an AMC announces a new mutual fund offering and 10 investors decide to put in 1,000 rupees each in this mutual fund. So each of these investors will hold 1 unit of this fund, and each unit's face value will be 1,000 rupees. This is also called the net asset value or NAV. Once this pool is ready, based on the type of fund that you have selected, the fund manager will then decide what portion of these funds to invest in stocks, what in bonds, and what remains in cash. This portfolio of a mutual fund is also known as assets under management or AUMs. So how does the value of your mutual fund move up or down? Let us suppose the investments of the fund manager worked well, and after 1 month, the value of this portfolio has moved up to 11,000 rupees. This would mean each of the investors will equally gain 100 rupees, and the net asset value of each unit will now move up to 1100 rupees. You can invest in a mutual fund in a lump sum manner or in smaller regular amounts through a systematic investment plan or an SIP. This will depend on your capacity to invest. To understand mutual funds better, let's go across to the MD and CEO of ICICI Prudential Asset Management Company, Mr. Nimesh Shah. Thanks very much for joining us, Mr. Shah. My first question to you is, how does a systematic investment plan work and what are its benefits?
The first thing is, when you are investing in equity, you have got 2 choices. So in a mutual fund, whether you invest it one time, whether you say, I invested one shot, I've got a sum of money and I want to invest it today, you invest it today. But then you are not sure whether the markets are going to go up, markets going to go down. So if you want to remove those uncertainty of timing, what people do is that people come in parts. Every month you keep on investing, so you average out your cost. So if the markets go down after that also, in 3 months time, if you are investing it every month, then as the market goes down, you are further investing. So over a period of time, your cost gets average out. So that is the reason of people going for systematic investment plans, that every 1st of the month or every 3rd of the month or every 7th of the month, you keep on investing a fixed set of money for the next 2 years, 3 years, 5 years, 10 years, depending on your goal. So we always say, look at what your final goal is. If you want to buy a house, then every month how much I should be investing.
There are different types of funds in a mutual fund. So you have equity funds, you have diversified funds, mid cap, large cap. So as an investor, how should one decide which fund to invest in?
See, for investors, it is best that they come into diversified equity funds, because over a period of time, your investment is diversified. So when we say an ICICI Prudential Dynamic Fund, what does it do? It invests in various industries. It does not invest in a sector fund will invest, say, in infrastructure. Then it will invest only in capital goods industry, or a banking fund will invest only in banking. For first-time investors who come into mutual fund, it is best that they come into diversified funds. So there is investment across various sectors.
So assume an investor does not want full exposure to equities. What kind of a fund can he invest in to reduce his risk?
See, there is another category of funds which is called a balanced category. So we have modulated it slightly so that it takes part equity and part debt. So basically, what is the problem? That the retail investors comes in when the market is very high and goes away when the market is very low. That is a problem that has happened. So what we do in this fund, we take money at any point of time. This fund will invest part in equity and part in debt. Okay. That is so today around 50 to 55 rupees it will invest in equity, remaining it will invest in debt. But suppose the market goes up, then they will reduce their equity exposure. Exactly reverse of what a retail investor will do. Okay. And when the markets become cheap, suppose the market goes down, then they will increase their equity composition.
What is the difference between a growth option and a dividend option? And how should one decide which one to opt for?
Actually, return-wise, it does not make any difference. It's a question of whether you want your money back at regular intervals, or you would take the money back only when you sell the mutual fund. So there are 2 types of people. My father would invest in a dividend option so that he gets return every month or every quarter or every year the way he wants it. So there are some people who go for dividend option where they want regular return every year. And there are people like me who are earning today, so their salary is supporting them today, so they don't need that returns every month, so they go for growth option.
What are the kind of fund management charges or commissions that are charged for mutual fund investments?
If you give me 100 rupees, I buy shares worth 100 rupees for you. There is no packaging involved in that. And there is a fixed charge per year that is charged to the customer. And it is a very, it is around 2% or 2 to 2.5% based on the level of the fund. It is 2 to 2.5% is charged to the fund. And it is a very transparent system before you get into the fund. And that is the only charge. There is no other charge that comes on the investor. And in some funds, if he goes away before 1 year, suppose he decides, then there is a slight of an exit load, which is 1% or something. If you invest in a Nifty directly, you don't need any expertise to, you can straight away go to the markets and buy Nifty, right? You get whatever, if the Nifty goes up by 20%, you get 20% return. So when we are active fund managers, as we are called, what we do is that we manage money on your behalf. So after our charges, do you get an incremental return? We are paid for to beating the benchmark.
And finally, my last question, what are the kind of tax benefits that one gets from mutual fund investments?
See, there are two things. One is when you invest in a mutual fund, you get that ATC benefit that has recently been increased also. But for that, you have to invest in some specific ELSS schemes, as they are called. If you invest in ELSS schemes, then you get that tax benefit in that one. But otherwise, there is another benefit of investing in mutual funds, that if you invest in an equity mutual fund, if you remove money after 1 year, there is practically no capital gains that comes onto a mutual fund. One is that you get, if you invest in those tax benefit schemes, you get that. But otherwise, after 1 year, if you sell, if you have taken units worth 100 rupees today, and they are worth 120 tomorrow, that is after 1 year, if you remove them, there is absolutely no taxation on that.